Hello and welcome to an Apex Signal strategy video. In this, I'll take a look at a standard deviation strategy. This operates under the assumption that markets tend to be very efficient. This is a statement that you'll hear repeatedly, and there is good reason for this, as there tends to be steady moves over longer-term charts. Unfortunately, most people don't look at the longer-term charts, and they tend to get stuck into the trap of trading short-term charts. Having said all of this, one of the best ways to trade financial markets is when they become inefficient or move too far, too fast. This is where standard deviation comes in. On the Euro-Swiss chart here, you can see that if I go ahead and plot a standard deviation indicator, it says period of 20. Now, what this means is it is showing me the deviation, the standard deviation as far as how far from a 20-day moving average on this daily chart. So I could go ahead and put the moving average here at 20 on the chart, and the two kind of coincide with each other. And what I mean by this is you have days where the standard deviation gets a little out of control. It shows you that you're moving a little too far, a little too quick. So for example, if I go ahead and zoom out to the weekly chart, you can see that this massive sell-off, and this would have been the Swiss bank giving up the peg, shot the standard deviation of from the moving average way into the stratosphere. Well, at that point in time, as you start to turn back around, it shows that we are trying to go back to normalcy. So that was a buy signal. When I go to the 4-hour chart, you can see, again, I have the moving average here just for illustrative purposes, but you can see that here we had spiked and the standard deviation had gone a little too far. Now, this can work in both directions. In this particular circumstance, it's just showing that it was a little overbought. Don't confuse a rising standard deviation with an overbought signal. It can be if we're going higher, but this would also rise if we fell quite drastically as well. The higher we go, the more deviation from a standard move that you're starting to see. And the whole idea is you're taking advantage of this market getting ahead of itself and trading against it. Here in the Euro Yen, you can see that I have a relatively quiet market, but we had a strong move to the upside. So if you were long of this market, and you can see that standard deviation was just way out of whack, and you can see that we are, especially right here at the highs, we had been way above there. That might have been a sign of it's time to get out. We're starting to get a little over exuberant in the market, and the long trader would have left. You could have sold. It certainly would have worked given enough time. It would have taken quite some time. But that is also quite often why people will use moving averages, just as an illustration of, okay, we are getting a little overdone. We're flattening out here. Maybe it's not worth selling and going against this overextended move. And then certainly almost immediately, several days later, you can see that we just fell off of a cliff here and we started to find normalcy. And that's the whole idea of this strategy, is that you're looking for inefficient, abnormal moves that you can trade against because you know the market typically will go back to normalcy.